Welcome. Let's talk money and build real wealth. There's a sentence that costs the average American somewhere between $100 and $200,000 over their lifetime, and almost everyone has said it. The sentence is, "I'll start investing next year." That 1 year of delay, just 12 months of telling yourself you'll get to it, doesn't cost you 1 year of returns. It costs you the compounded growth on those returns for every single year that follows. And today I'm going to show you exactly how that math works, because once you see it, you can't unsee it. Here's what most people get wrong about this. They think delaying 1 year costs them 1 year of gains. Like, okay, I missed out on maybe 7 or 8%, no big deal. But that's not how compounding works. Compounding doesn't add, it multiplies. And every year you wait, you're not just losing that year's slice. You're losing the snowball that slice would have become over the next 20 or 30 years. By the end of this video, you're going to see the actual dollar gap between starting now and starting 12 months from now. And I'll be honest, the number is uncomfortable, but you'll also walk away with a clear framework for what to actually do about it, even if your budget is tight. So let's talk about why smart, capable adults keep drifting into this trap. It's not because people are lazy, it's because the cost of waiting is invisible. If you skip the gym for a year, you can feel it. If you skip investing for a year, nothing happens. Your bank account looks the same. Your life looks the same. The damage is entirely in the future. And our brains are terrible at weighing future consequences against present comfort. There's also this quiet assumption that next year will be better. I'll make more money, I'll have fewer expenses, the market will be in a better spot. But here's the thing. Research from Harvard Business School emphasizes that investment time horizon is arguably the most critical factor in investment success. Not timing, not picking the right stock, time in the market. The length of time your money is actually working, and every year you wait, that horizon shrinks. You don't get it back. All right, let's run the numbers. And I want to be upfront. These are illustrative, not guarantees. Nobody knows what the market will return. But let's use a reasonable long-term average. Say you're 32. You plan to invest $500 a month until you're 65. That's 33 years. If your investments grow at a hypothetical 7% annually, which is roughly in line with long-term historical stock market averages after inflation, you'd end up with around $790,000. Now let's say you wait 1 year. Same monthly amount, same rate of return, but 32 years instead of 33. You'd end up with roughly $735,000. That's a gap of about $55,000. From 1 year. 1 year of saying, I'll get to it. And that's at $500 a month. If you're investing $750 or $1,000 a month, that gap scales proportionally. We're talking 6 figures lost to a single year of procrastination. Here's the part that really messes with people's intuition. In compounding, the growth is backloaded. The early years feel like nothing is happening. You put in $6,000 in year 1 and then maybe you gain $400. Cool, a nice dinner. But in year 28, 29, 30, your portfolio might be generating $40,000, $50,000, $60,000 a year in growth alone. That's not you contributing, that's your money making money on the money it already made. So when you cut off the last year of your investment timeline, which is exactly what delaying by 1 year does, you're not cutting off a small early year. You're cutting off the most powerful year, the year where compounding is doing its heaviest lifting. That's why the cost is so disproportionate. You lose 12 months on the calendar, but you lose the fattest year on the growth curve. This is the objection I hear constantly. What if I invest today and the market tanks tomorrow? Fair question, but let's look at what actually happens historically. During the COVID crash in early 2020, markets dropped roughly 34% in about a month. Terrifying, but by the end of 2021, US housing prices had soared past 2019 levels, and the stock market had not only recovered, but hit new highs. People who stayed invested through that chaos came out ahead. People who pulled out or never started. They locked in the loss or missed the recovery entirely. Here's the uncomfortable truth. There's never a year where the coast looks perfectly clear. There's always a reason to wait. Inflation is too high, interest rates are weird, there's an election, there's a war, the market feels toppy. If you wait for the perfect moment, you will wait forever. And waiting forever has a price tag. Now here's where I want to challenge something you might be assuming. The biggest cost of waiting one more year isn't actually the dollars, it's the habit. Because people who say next year once almost always say it again and again. Waiting becomes the default. It becomes your financial identity, someone who's going to start investing someday. And that identity compounds too, just in the wrong direction. Every year you don't invest, you get more comfortable not investing. The activation energy to start gets higher, not lower. You'd think it would get easier. You're making more money, you know more. But psychologically, the gap between where you are and where you feel you should be gets wider. And that gap creates shame, and shame creates avoidance. So the real cost of 1 year isn't $55,000. It's the risk that 1 year becomes 5, or 10, or the rest of your working life. And by the way, this isn't just personal finance advice. The biggest, most sophisticated investors in the world operate on this exact principle. Venture capital funds typically lock up money for around 10 years. Institutional real estate investors hold properties for an average of 7.6 years. These are people managing billions of dollars, and their entire strategy is built around giving their investments enough time to compound and recover from setbacks. They're not trying to time the market. They're buying time in the market. If the smartest money in the world is optimizing for a time horizon above almost everything else, maybe that's a signal worth paying attention to. Okay, so what do you actually do with this information? Here are 4 concrete moves. First, start with whatever you have. Seriously, if it's $50 a month, start with $50 a month. The amount matters less than breaking the inertia. You can optimize later. The critical thing is that your money starts compounding now, not next January. Second, automate it. Set up an automatic transfer from your checking account into a broad market index fund inside a tax-advantaged retirement account. The less you have to think about it, the less likely you are to talk yourself out of it. Third, ignore the noise. You don't need to know what the Fed is doing. You don't need to have an opinion on whether the market is overvalued. For a long-term investor with a 20-plus year horizon, this month's headlines are irrelevant. Your job is to keep contributing consistently. Fourth, do the math for your own situation. Grab a compound interest calculator, there are free ones everywhere, and plug in your numbers. Your age, your target retirement age, what you can contribute monthly. Then run it again with 1 fewer year. See the gap for yourself. That number is personal, and it's motivating in a way that no video can replicate. Look, the market doesn't care about your intentions. It doesn't give you credit for planning to invest. It only rewards the people who actually did it. And the best time to start was 10 years ago. The second best time is right now, not next month, not next quarter, not next year. Right now. If this reframed how you think about the cost of waiting, hit subscribe. I make videos like this regularly, breaking down the quiet financial mistakes that most people don't catch until they've already compounded. Thanks for watching. Subscribe for more finance insights every week.